I think the trigger will surprise people. When the momentum gets established in the gold stocks, what I think that you'll see, likely, and I don't want to give your people too much hope, but I think it'll gap up. That's what's happened in past markets. When you exhaust the sellers, for people who are willing to work hard, who are tolerant of volatility, tolerant of risk, and have the financial capability to stay under risk, there is no sector that I could think of that has the potential to be more fun than silver.
With the gold price historically high, market participants are hoping much-beleaguered gold equities are next. Commenting on the wide gap between the yellow metal and gold stock values, Rick Rule, proprietor at Rule Investment Media, told, "I have not seen as great a disconnect between the gold price and the gold stocks in my career. And yet, he believes that the fact that nobody wants to be in gold equities is their greatest asset." This disparity reminds Rick of the early 70s when there wasn't such a notable disconnect between gold prices and stocks. Investor sentiment toward gold stocks hasn't been this negative since that era. Moreover, the current valuation of gold stocks, compared to their book value or free cash flow, is at unprecedented lows, indicating a market downturn. Unfortunately, the mining industry's poor performance over the past 5 decades has worsened this situation. Despite a significant increase in gold prices from 2000 to 2010, the free cash flow per share of major gold indices has declined steadily. This decline persisted even in the face of significant price increases, highlighting a concerning trend. While the gold mining sector may seem gloomy at present, there are promising prospects within top-tier companies. A turnaround could occur unexpectedly, possibly when sellers run out of steam, leading to a sudden price uptick. Despite uncertainties about when this might happen, Rick is optimistic about the potential for a bull market in gold equities, which could yield substantial returns for resilient investors. Rick also raises concerns about the challenges silver mining companies face, as newly mined silver contributes only a small fraction of the total supply. However, silver stocks tend to experience significant volatility during a silver bull market. Rick recommends considering allocating a portion of one's portfolio to silver equities, although it requires patience and tolerance for volatility to succeed in this venture. We will present clips from Rick Rule's interview with Investing News. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
I think the trigger will surprise people. I think what will happen is that sellers would become exhausted. I think that's what's going to happen. The sellers will become exhausted, and the bids won't get filled. When the momentum gets established in the gold stocks, what I think that you'll see, likely, and I don't want to give your people too much hope, but I think it'll gap up. That's what's happened in past markets. When you exhaust the sellers, it gaps up. Here's an interesting statistic for you, Sean. Maybe I've used it before. Precious metals and precious metals equities comprise less than 0.5% of the total savings and investment assets in the United States. Less than 0.5%. The 4-decade mean is 2%. If the market share of precious metals and precious metals-related assets returns to mean, demand for them increases 4-fold. And that's what I think happens. Does it happen in 2 years, 3 years, 4 years? I don't know. I have no idea. What I do know is that a gold bull market, a gold equity bull market, is such a profound event that if you're 2 years early, like I was on uranium, it doesn't matter. The amount of money you make, particularly given the fairly low level of risk, at absolute risk, that you experience deploying capital now, is silly. The silver stocks are for real speculators. I mean, you need to understand that. Too many people, when they look at silver miners and they talk about the deficit, neglect the fact that silver mining companies are fairly small sources of silver, which is to say new mined silver accounts for about 17% of silver supply. Recycling and byproduct production from other mines accounts for most of the supply, which puts the silver miners at a disadvantage. That being said, there is no class of securities that I know of that has more volatility to the upside than silver stocks in the silver bull market. I personally have a goal in the next year and a half to get the allocation of silver equities in my own portfolio up to 2.5%, which is a fairly small number. I believe that 2.5% could if I'm correct about the direction of the silver market, come to comprise 25% of my portfolio through capital gains. The idea that you allocate on a risk-reward basis, 2.5% is my number. If things go wrong, I lose 1.5% of my portfolio. If things go right, I make 10 times my money. That juxtaposition of risk to reward is something that's extreme attractive to me. Speculators who are thinking about doing that need to take into account, first of all, whether or not they're patient with to do it. It could easily take 2 years or 3 years. Easily. I could be wrong. So they need to take into account their tolerance for absolute loss, and they need to work hard to look through the flotsam and jetsam among the silver stocks and find the real ones. For people who are willing to work hard, who are tolerant of volatility, tolerant of risk, and have the financial capability to stay under risk, there is no sector that I could think of that has the potential to be more fun than silver.
Inflation, which peaked at 7.1% in 2022, as per the Fed's preferred measure, declined to 2.6% for all of 2023. In the latter half of last year, price growth stabilized at a 2% annual rate, meeting the Fed's target. Economists expected the Fed's first rate cut, likely in May or June. Despite numerous hikes in 2022 and 2023, the rate presently stands at approximately 5.4%, a 22-year high. The anticipated impact of rising interest rates on the economy included expectations for a slowdown in housing starts and durable goods sales. However, Rick highlights a surprising resilience in the U.S. economy. This resilience is evident in equity markets, notably in major tech stocks, wage growth, and employment figures. Nevertheless, despite these positive indicators, many Americans continue to grapple with financial challenges, with wage hikes potentially failing to offset the mounting costs of goods and services. Furthermore, the upcoming elections will greatly impact the U.S. economy beyond 2024, creating immediate uncertainty. Rick believes that many people will likely feel disillusioned regardless of the election outcome. However, significant changes in economic and fiscal policies are unlikely in the market. Both candidates lack a history of fiscal responsibility, suggesting a continuation of loose monetary and fiscal policies driven by re-election concerns. This may offer short-term stimulus, but raises concerns about long-term debt accumulation. Let's get back to the interview.
I had anticipated that the increase in interest rates that we've seen would have had a harder effect on the economy. I would have expected the housing starts to be slower. I would have expected durable goods sales to be lower. I am pleasantly surprised by the strength in the U.S. economy. It is true that some of that strength is focused, as an example, in the equities markets. The great big tech stocks, the world dominators, seem to be the ones that are catching most of the bids. But I'm also surprised by wage strength. I'm surprised by the employment statistics. I'm cognizant of the fact that many Americans are suffering, that the wages that people are being paid do not necessarily compensate them well for the increase in the prices of goods and services that they consume. So I'm not suggesting that the economic strength that I see in the United States in particular has benefited everyone. But I am still surprised by the strength in the U.S. economy after those interest rate increases. Well, there's a lot of cash in the system, first of all. People have been afraid for a long time about the possibility of recession. Were we to have a recession with relatively high interest rates, there is a chance that you could have a liquidity squeeze, like 2008. People are nervous about that. The consequence of them being nervous is that there's $6 trillion cash in money market funds. And some of that cash now is finding its way back into the market. Your listeners need to be aware of the fact that the equity market strength is very concentrated strength. If you look at the S&P 500, which has done well, there are something like 10 stocks beyond the Magnificent Seven that have driven that market. So the market breadth, from the equity market breadth, is lousy. And the bond market the long bond market is still lousy. It's important to note that a lot of the strength is concentrated. And people do need to be aware of that. I think, in more direct answer to your question, that whoever wins, there will not be a major change in economic and fiscal policy. Neither Mr. Trump nor Mr. Biden are world famous for attempting to save taxpayers' money. I think in particular that there's pressure on the Fed from the Democrats to pursue a much more accommodative monetary policy because they want to get reelected. Unfortunately, I expect monetary policy and fiscal policy to be very loose, no matter who wins. I think that will probably give us artificial stimulus in 2024 and 2025. But at some point in time, Charlotte, we need to pay the pipe. We need to address the endemic debt and deficit in American society. I don't know when that happens. I don't know who it happens. I know it has to happen, and I know it's going to be distinctly unpleasant when it does.
In terms of timing when to get into gold stocks, the experts suggested positioning before the Fed makes its first rate cut. Brian London, the editor of Gold Newsletter, highlights that undervalued gold stocks are currently offered at bargain prices. Investors in gold stocks have long-awaited movement in their holdings, and London foresees a surge once the price of gold exceeds $2,150 and demonstrates a clear breakout on the charts. Don't forget to share your thoughts on Rick Rule's observation in the comment section below. Also, be sure to like this video, subscribe to the channel, and turn on post notifications for more content like this. Thanks for watching.